Here's the nasty, nasty stuff that the FTB is doing, saying basically if you have an entity that you're actively doing management, which means telephone calls, emails, bank accounts here, writing checks, that you're supposed to be qualified to do business here and pay taxes here. The nasty language is if it's a partnership and you have the possibility of managing in California because you're a resident, you owe taxes. And with the Franchise Tax Board, who has the burden to prove that you're innocent? You do. So they make the assumption and you have to prove, like, here's the airline tickets, here's the hotel, here's my ledger where I talked to the property manager, here's where I reviewed the properties, all those types of things. People don't want to do that. And the Franchise Tax Board is really cracking down on it. So you need to be careful. So, part of your question is, yes, you need to have entities and preferably multiple entities. You may want to have an entity just to manage. Everybody remember the case down in San Jose? Where the landlord had known that the tenant below always complained about the older lady above that had the TV up way too loud. And they both complained about each other. He'd bang the ceiling with a stick. And they'd be screaming and yelling at each other. That went on 3 years. Anybody remember what happened?
No.
They killed each other.
He went up and killed the older lady, yeah. So, what's more risky, owning the building or managing? Managing.
If you're managing in California, what kind of entity would you use? Would you suggest?
That's not as easy an answer to give you. Is it non-California real estate?
California real estate.
Oh boy.
Make it worse, make it San Francisco.
I'll give you a 2-minute spiel on the really nice weather tax in the state of California. Under Proposition 13, when you buy a piece of property in California, how much can the assessed roll value go up per year? 2% or CPI, whichever is less. We actually had 1 year where it was not 2%. How much are the property taxes constitutionally guaranteed to be? 1%. We always say 1 1/4 because you've got the mosquito abatement district, you've got the library fee, you got all these other things that add up. So what's Prop 58?
Fair child transfer.
Yep. So Proposition 58 is if a piece of California property goes from the parent to the child by a sale, gift, or inheritance, that is not a reassessable event under Proposition 13. The key words are, it's a real property interest. If you have real property in an LLC, multi-member, doing everything you're supposed to, and you give the membership units to your child, is that personal property or real property? It's personal property. Different rules apply under Prop 58. Change of control or 50+%, 100% gets reassessed. That's why I said it's not an easy answer in California. It's an easy answer if you tell me when you're going to die. Because a couple days before, we'll roll it out of the LLC so you own it in your name, and then it's a real property transfer.
No, I just mean managing. If you own California properties and they're owned in your LLCs,
Yeah.
but you want a separate company to manage them,
Yeah.
would you also have that as an LLC?
Yes, ma'am.
Or would you have it in the S corp?
No, I would have it as an entity itself.
In an LLC.
I'd pay a W-2, I'd have a 401k, I'd have a profit sharing, I'd have a defined benefit plan.
Do that as an LLC instead of a corporation.
Either way,
Okay.
it's whatever you're comfortable with. Corporation, you do have to have the meetings, which are usually about 5 minutes.
Thank you.
Yeah. And by the way, does everybody have meetings for their entities, for their business? probably every other day you have a meeting. Right? Do I sell? Do I buy another one? Do I have adequate insurance? What am I doing? You've had the meeting. You just don't put it in paper. It's not that you're not holding meetings, because you are. It's just you're not formalizing in paper. And that's what you're required to do with a corporation. You're not required to do with an LLC. Does that make some sense? So again, if you've owned property, like my neighbor who bought in 1948 in Los Altos, pays less than $100 a month in property taxes, he's going to leave that to his 2 kids. It's not going to be reassessed. They will continue paying the $100 a month in real property taxes. Does it end there? Forgot to tell you, they both have children also. Parent to child, parent to child, parent to child, parent to child, parent to child. So again, it's a great asset, but only for assets of real property in the state of California. You're blessed to own rental property here. Okay, thank you. You're blessed to own rental property here. We actually have a couple clients that bought warehouses in South San Francisco in the 60s. Their assessed roll value is $400,000. I'm not making that up. I know their property taxes are $5,000 a year. They're worth about $8 million. What's 1.25 times 8? Somebody help me. Is that around 100,000? That's what would happen if they don't follow Prop 58. The family loses $95,000. Not only do they lose $95,000 a year, but 2% of 400 is what? Versus 2% of 8 million. So the snowball grows. But that's only in California. Only California has Prop 13. So that's part of the wealth preservation in the state of California. You're limited to $1 million of assessed roll value on non-primary resident. Not fair market value, not basis. Assessed roll value. It's that little letter you get once a year that says the building's worth this, the land's worth this, and there's this really nice gift, right? The homeowner's exemption. How much is that? It's $7,000. They're really generous. So that's one of the nice things about owning real property in California. So they get you with a lot of other things. By the way, what are we number 1 in currently?
Taxes.
Income tax. 13.3. So we are the highest tax rate for income tax. We used to be 3, but the voters passed the tax, remember, to add 3% more to themselves. So again, there's a lot you can do. The main reasons you're doing is for income tax purposes, for wealth transfer purposes, avoiding gift and inheritance tax, and as a side, you're getting creditor protection. So if you remember nothing else, you get up on the stand, oh my God, the attorney said there were so many different things. I can't even tell you everything he said why we're doing this stuff. You're going to sound a lot better than, oh, we did it for creditor protection. So everybody got that down cold? Okay. Yes, sir.
Just on the inheriting of real estate in California, if it's owned by a living trust, is that real property?
Correct. If it's a revocable living trust, not an irrevocable trust. If it's a revocable living trust, it's still considered transfer of real property.
Real.
The issue becomes, like myself, I have 3 kids, I own 1 home. What's the assessor going to want to do? If one child gets the home, the other 2 get other things, what's the assessor going to want to do? Say it's no longer parent to child, it's sibling to sibling, and we're going to reassess 2/3. So you got to be really careful how you do things. That's only California. No other state has it. So if you're investing outside California, you don't need to worry about that. It makes it easier.
So you say you have to file on the Prop 58. Is that what you said?
No, what you actually do, as long as you filed a homeowner's exemption, then the assessor says that's your primary residence. And because of that, then you're allowed to use Prop 58.
But then your primary residence should not be LLC because then you
No,
can't do it.
no. That's one of the fatal flaws. If you try to, would anybody put their house into an LLC for anything other than creditor protection? The courts say no. That's the one thing that you kind of need to leave alone. Now, there's nothing stopping you from giving bits and pieces of it, a 1% or 2%, to a child's irrevocable trust. You can do that type of thing. What's the other thing that you get with entities? I forgot to set my timer, so I don't know. 5 minutes. Okay, thank you. What's the other thing that I haven't even talked about entities that you can do? I'll give you a hint. It's inheritance taxes and gift taxes. If you only own 10% of a business and you try to sell that 10% to someone else, and if the business is worth $1 million, is anybody going to pay $100,000 to go into business with somebody they don't know? The answer is probably not. What do you think the IRS allows you to do?
Discount.
To take discounts on those assets. Because it's a minority interest, you don't have control, lack of marketability, all those things, you can take 25%. So you can get a discount for inheritance and gift tax purposes, and or sales to children. So there's just a lot of reasons why you can do these things that don't say wealth preservation, asset protection. You're doing it for all these other things. And if the IRS is arguing with you, what do you say? It's for asset protection. If the creditor is arguing with you, it was for tax protection. I was able to give stuff to kids over a long time period. I'm not subject to 40% gift tax. I'm not subject to 40% inheritance tax. I'm not subject to all these things. I'm now able to keep the family wealth in one. I can do loans to the family so they can buy stuff. So my cash flow is protected. All these legitimate reasons why people do things that aren't credit protection. And the more you have and the more frequently you do it, the better off you are.